Keith, I'm going to start with you because we have the S&P closing above 4,900, 4,927 to be exact. It's a new record close for the broader market. What does history tell us when we see this type of momentum happening with records for the market?
Yeah, well, great to be with you, Morgan and John. So history, which is just the starting point, is actually favorable when we make an all-time high after not doing so for more than a year. In fact, when we go back to 1950s, we've seen this happen about 14 times, and 13 out of 14 times the market was higher a year later. Now, the one caveat, the outlier in that data, was the recession in May of following the May 07 signal. So it's not a perfect indicator, but I will say that that's a positive. The other thing I will say, coming into this year, the market was stretched to overbought. We looked at that as a good overbought. The market churned sideways for a few weeks to start the year. You start to see sentiment come in as well, but there's been no issues on the credit markets, and we're seeing earning estimates continue to rise as well. So the valuations are certainly rich, but I do think you have to respect the underlying trend, and we think that trend is still higher as we progress through this year.
Yeah, Scott, I want to get your thoughts on valuations. You've got an S&P trading at, what, 20 times earnings right now? But in some ways, maybe that's a little bit of a misnomer because, and we're going to see this week, right, with 5 members of the Magnificent Seven reporting. But we know how top-heavy the indexes have been because of the rallies in these AI-related tech stocks.
Well, Morgan, I tell you, AI, most companies, it's going to take a long time to monetize that. And, stocks are not cheap. I mean, valuations are high. We have a 230 number out there for the S&P 500. So you're talking, 21 times earnings. Now, of course, we're at the lower end of the scale. We're below consensus. We think these estimates are too high out there for 11 or 12% growth. But, let's face it, we have a few people, reputable people out on the street. They're looking for 250, 252. So if you do the math there, and they're right, valuations don't look that stretched. We think we're eventually, by the end of this year and into 2025, we're moving into a modest growth, modest inflation environment. That typically means valuations are going to be higher than the longer-term average. So, what we're trying to do, given the fact that we think the 3 sectors you mentioned that outperformed today, they've outperformed dramatically over the last 12 months, that's where we want to trim. And we want to look at sectors like energy, industrials, materials, healthcare that have trailed. So we're trying to adjust portfolios. We're not just sitting here watching the market go higher. We're not going to chase it. In other words, we're not just going to buy the S&P here. But I think there's some things inside of portfolios that people can do to take advantage of the hot stocks, ease up there, and then, maybe buy a little bit of sectors exposure that's trailed.